Assalamu alaikum friends, welcome to SBR revision series for September 2021, and today we are going to cover IFRS 15 revenue from contracts with customer. So here we are going to cover the 5-step approach to revenue recognition. There are 5 steps, okay, that you have to go through before you recognize revenue finally. And then identify so these are the steps. First, identify the contract. Okay, we are going to go in detail in all these 5 steps. How do you identify the contract? Second, identify the performance obligation. Third, determine the transaction price. Fourth, allocate the transaction price. Fifth, you recognize the revenue. So these are the 5 steps we are going to go in depth. And finally, contract cost. How are we going to deal with contract cost? Remember, the name of the standard is revenue from customers with contract. That means we are having a contract. From that, if we fulfill the contract, both parties revenue is recognized. But there are some cost also of that contract. That's why we have to know how to deal with that contract cost also. So whenever they give you a contract cost, contract is given, you should know that you have to use IFRS 15 to deal with it. Okay, and it's very simple. It's nothing difficult. It's very small also. So let's start with revenue recognition, the 5 steps model. Okay, number 1, it's there in the topics is given. You identify a contract with a customer. First, you should know that there's a contract that exists. Okay, there's a contract with a customer. Without a contract, you cannot recognize revenue. Simple. So first step has to be there. Second, identify the performance obligation within the contract. Performance obligation means what are you supposed to supply, goods or services? Which good are you supposed to supply or services? It has to be there in the contract. Third, transaction price. This is the price that organizations or entities are entitled to receive after they fulfill their obligation. Allocate the transaction price to the performance obligations within the contract. Now, under the same contract, there might be more than one performance obligation, 2, 3, maybe 2, 3 goods or services you might have to give to the customer. So for that, transaction price you have to allocate among them, among all the performance obligation. Fifth, recognize revenue when or as a performance obligation is satisfied. So we recognize revenue when performance obligation is satisfied. Okay. Remember, whenever a question comes on IFRS 15, okay, don't go and sit and start giving from number 1. Don't start listing all the 5 steps of revenue recognition. No, question will never ask you like this. This is professional level exam. This is not UF level. They will not ask you what is the 5 step to revenue recognition. Identify all the 5 steps, explain in detail the 5 steps. Is not. Out of this 5, maybe any 1 or 2 you might need to use depending on your scenario that is given to you. Okay, and mostly it is the last 2 steps, 4 and 5. Okay, so let's start with step number 1, identify the contract. Okay, IFRS 15 says contract means any agreement that is between 2 parties. Okay, and that creates a right and obligation. That means one party will be having a right to receive from another party, the other party will have an obligation to pay to the other party. One party is receiving, the other party has to pay. So it's like that. That is called as contract. Okay, so there has to be this following criteria needs to be there if you have to recognize the revenue from contract. Okay, number 1, parties have approved the contract and each party's right can be identified. Both the parties, number 1, they should have to approve the contract and their rights you can identify from the contract that this party is going to receive this party has to pay this much. Then payment terms can be identified. That is the transaction price. Payment terms. Because a contract without a payment, then you cannot recognize revenue. Okay, payment term also has to be clear. Contract must have commercial substance. Now we are talking about the contract. That contract has to have 2 parties. Both parties must have approved the contract and their rights also have to be identified. Payment terms have to be identified. Contract should have commercial substance. Okay, commercial substance means is for commercial reasons that contract is. For example, that contract is for me to supply you 12 chairs. That's a commercial substance. Okay, nothing personal there. And it is probable that the selling entity will receive consideration. The one who is selling, they should have the right. There's a probability that they are going to receive some amount, some money, consideration. If these four things are there, then only from that contract you can recognize revenue. Otherwise, from that contract, if it was some other contract, let's say one of these features are missing in that contract, you cannot recognize a revenue. For example, you have the payment term, sorry, you have the commercial substance. It is probable that you're going to receive the consideration. Parties right is also there, but payment term is not identified. No one knows what is the payment amount. The term is not there. Then that contract is not known as, you cannot recognize revenue from that contract. Yes, it's a contract, but you cannot account for revenue. Okay, it should meet all the four criterias. Okay, then only it's known as contract. Then only it is called contract with customer contract. First of all, that contract has to be identified because it is revenue from contract. If contract is already not identified, how are you going to recognize revenue? Second, identify the performance obligation, the second step in your revenue recognition model. Okay, so performance obligations are distinct goods or services that you promise that you're going to supply to the customer. So performance obligation 1, performance obligation 2. Yes, a contract might have different performance obligation. Okay, one example is IT. For example, in the IT, they might supply you with a computer as well as some services, additional services, 1 year service or something like that. So that computer is one performance obligation 1, and that additional service that you're going to give to your supplier over the 1 year is performance obligation 2. Okay, how does entity determine the nature of their performance obligation? They have to determine the nature also. They might be a principal. Principal means entity is directly providing that good or service to the customer, or they might be an agent. That means on behalf of someone else, they are going to give these goods and services to the customer. Okay, directly they are not supplying. They have appointed an agent, and that agent, through that agent, they are going to sell the goods or services. Okay, so an entity is the principal if it controls the goods or services. Just see who is controlling the goods or service. If the entity has the control of that goods and services before giving it to the customer, entity is known as the principal. That means entity can recognize the revenue. But for agent, if you are giving it through an agent, then the way you recognize revenue will change. You directly cannot recognize revenue like that. Then you have to pay some commission, some fees to the agent also. That also you have to deduct from the revenue that you're going to receive, and then you have to recognize a revenue. Okay. Third, transaction price. How do you determine the transaction price? So this transaction price, okay, is the amount that you are entitled to receive once you have fulfilled the performance obligation. That means you have supplied the good or services to the customer. Then you're going to get this price. Okay. So transaction price, remember, can be in various form, not only in cash. It could be in a variable consideration. That means consideration will change. Variable. Non-cash consideration. It need not be in cash. Consideration that payable to customer. Sometimes you have to pay to the customer. There are some even like that. Okay, we'll come to that later in depth. Financing. So these are the four ways a transaction price can be. Now let us go in depth in these four types of transaction. Number one, variable consideration. For example, a bonuses or a penalty. Okay, you might receive a bonus from the customer, or you might receive a penalty. That means you might receive less than what you're supposed to receive. That was determined in the contract initially. So seller must estimate the amount expected to be received. Okay, this estimate is, so variable consideration, how do you calculate variable consideration? It's just like you are estimating, you're just making an estimate. The seller is making this estimate that is going to get this much of money. Okay, so this estimate is included in the transaction price. Yes, if you have to include it, this will come in the transaction price. You will add it. For example, you have expected, the seller is expected that is going to get 5 million. This 5 million will be included in that transaction price when you are initially making up that contract, because in that contract you have to give a transaction price also, right? So you will put this variable consideration there. But remember, there's one condition attached to this. If you are taking variable consideration, This estimate is already included in the transaction price if it is highly probable that a significant reversal in the amount of revenue recognized will not occur when the uncertainty is resolved. What does it mean? That means you are initially, now you're estimating, you don't know what's going to happen in the future. You're just making an estimate now, right? So later, if that estimate, okay, turns out to be not true, not correct, okay, so after that, your revenue should not change based on that estimate that you have made today. If it's not changed, then only you can take it in the transaction price, otherwise no. Okay, if you are sure that if your transaction price changes, the revenue will change, it will reverse, then you cannot take it as a transaction price. Okay, it should remain the same. There should not be a reversal of the amount revenue that you have recognized today based on that transaction price, because in that transaction price you've included variable consideration also. Okay, there should be a high, the probability should be high that revenue is not going to change, revenue is not going to reverse significantly, it will not going to reverse. That means significant, it will not change. Okay, even if later you come to know that this is not, the estimate is not correct, you are now trying to change it, you are trying to put the correct amount, right? Revenue should not change that time. That means today you have recognized a revenue, that revenue should not change later on, reverse later on, probability should be high, then only. Definitely with my explanation, with just going through textbook, it's harder to understand this point. You have to do a question with the numbers for this, where this thing has happened, reversal of revenue and not reversal of revenue. Second one is financing. If there's a significant financing component that you have used, that means a consideration receivable must be discounted to present value. Okay, what is significant financing component? You have taken on a finance, you have, right? That means you have received something in advance. You have received something in advance. So that is a consideration receivable. That should be accounted as a consideration receivable and must be discounted to present value. You have to discount it to the present value. If there's a significant financing component, then otherwise no need. Then non-cash consideration. If anything is at non-cash, whatever it is, shares or anything, measure it at fair value. And consideration that is payable to a customer, this is deducted from the transaction price. Remember, if you are paying anything to the customer, you have to deduct it from the transaction price that you have calculated. Okay, so this is how you have to calculate the transaction price. If all these four are there, then you have to add all those four and find the transaction price. How do you allocate the transaction price among the different performance obligation? Okay, so the total transaction price, remember in the contract they will not tell you for this is the transaction price for this. No, they will only give you one transaction price, and that transaction price is the total of both the performance obligation, two or three or how many perform, however. But you have to know how to allocate that total transaction price among these various performance obligation in proportion to the standalone selling price. Selling prices will be given for each performance obligation. So based on that, you'll be able to find out. Calculation on all, I didn't include it in this video, but it is there under my IFRS 15 video. So you can go and check it out. Okay. So this transaction price, one transaction price will be allocated between the two performance obligation based on their selling price, because for performance obligation one selling price will be given, for performance obligation two selling price will be given separately, it will be given. So based on that selling price you can find out the transaction price also. Now recognize the revenue. This is the final step where you have to recognize the revenue. Remember, revenue you can recognize in two ways: recognize revenue at a point in time and recognize revenue over a period of time. But before coming to that, okay, first of all, when do you recognize revenue? Revenue is recognized when the entity satisfies a performance obligation. That's it. Today he satisfied, today he supplied the goods and services, today he will recognize revenue. Okay, and If this criteria are met, if any one of this criteria is satisfied, revenue will be recognized over time. Okay, that means you have satisfied this performance obligation over time. Usually this is true for the services. Why? Because services you usually supply over time. It's not like a good that today I give to my customer, the control goes to the customer. No, services usually over the time period you give. So revenue also you recognize it like that. So let us see what are those criteria. Number one, where the customers are receiving also and they are getting the benefit also simultaneously. Then the entity is performing that services. For example, me, I am teaching you here right now, right? So I am doing my performance. I am teaching you also, and you are getting the benefit also out of it. You can hear me, right? So you're receiving the benefit. So it's happening simultaneously. So this is an example of a revenue that I have to recognize over a period of time. Second, entity is creating or enhancing an asset controlled by the customer. Okay. So you, for example, the computer I was talking about, the computer you have given to the customer has the control of that computer, but now you are doing some additional services there, after sale service for 1 year you will be giving, let's say. So for that after sale service will enhance that performance of that asset. It will be beneficial for the customer. It will create or enhance that asset, that computer for the customer. So this is also an example of where you can recognize revenue over time. And third, entity cannot use the asset for an alternative use, and the entity can demand payment for its performance to date. You cannot use it for alternative use. Okay, you have to use it for the purpose which it is intended to use for. Then you can recognize it over time. Okay, and the entity can demand also the payment for its performance to date. For example, one example is construction of building. You have promised to build a construction of building to a customer. Usually construction of building is a good example because it is usually performed over a period of time, 3-4 years. Let's say 4 years is taken. So during this 4 years, okay, you are constructing a building for what? For a customer. It is customized according to him. Now you cannot use this building for some alternative use. Entity cannot use it for some alternative use. Let's say he's using it for a particular use and you have built it up in such a way, you have constructed in such a way that entity, that it can only be used for something, some particular stuff. It cannot be used for general things. Then you cannot use it for an alternative use. And also you can demand the payment also. Let's say out of the 4 year you have done the building for 2 years. For those 2 years now, after you can demand for the payment because I have completed for those 2 years, right? So whatever you have completed out of those 4 years, within that 2 years, you can demand for that payment from the customer. So this is also over time. That means you can recognize revenue over time in these three conditions. Otherwise, it will be at a point in time. If these three conditions are not there, if these three criteria are not met, revenue will be recognized at a point in time. Okay. So as you can see, revenue is recognized. How do you recognize revenue over time when it is satisfied over time? On the progress towards completion. This is the method. Whatever the progress you have made till the completion, you will recognize revenue up to that much. For example, you have built a building up to 60% only. Only 60% of that revenue you will recognize. And at a point in time, how do you recognize it at a point in time? How do you know it's at a point in time? When the control goes to the customer is the one who's controlling that asset now. Then you say it's satisfied at a point in time, not over a period of time. Okay. But first of all, you have to first see these three criteria are met or not, whether it is satisfied over a period of time or not. If it is not satisfied over a period of time, then you go and check whether it is satisfied at a point in time or not. And how do you know it? See who is having the control. Because at a point in time means control have to go to customer. Okay. Now that's it for the revenue part. Coming to the contract cost. So two types of cost are there relating to contract, and you have to capitalize both. Capitalize both means it will come as an asset. Number one, Cost of obtaining a contract. Any cost of obtaining a contract, capitalize it. Second type of cost is cost of fulfilling a contract. Remember, to obtain a contract, to get that contract and to fulfill that contract also have some cost. So that also will be, you can capitalize it. Both the costs are capitalized. Obtaining contract, fulfilling contract. But for fulfilling contract, you have to see that it does not fall in the scope of another standard. One example is inventory. If it falls under the scope of inventory, then you cannot capitalize it. Then you have to use IS2 inventory. If it does not fall in the scope of IS2 or another standard, then only you can capitalize it. That means it will be taken as an asset, whatever the cost of contract asset. So from your exam kit questions, you can do this three: ZTech, Kasun, and Verge. I think I have completed ZTech. Kasun and Verge is yet to be done. Inshallah, I will cover that in September for September exam. So till then, thanks for watching. In the next standard, I'll be covering IFRS 16, which is leases. Another very interesting standard. Until then, thanks for watching.